When you're looking at mutual fund returns, and when you screen through them, you see some of these funds with abnormally high returns than your large or mid or small cap funds, and you're wondering whether to invest in them. Hold there. Go through this video before you decide to invest in them. Yes, we are talking about sector funds and thematic funds. These are funds that can generate very high returns for you simply because they invest in focused themes or sectors. For example, if you take sector funds, they invest in very specific sectors. Say they can be an IT fund, they can be an infrastructure fund, they can be a banking and financial services fund, and so on. So they just pick one sector out of the plenty of sectors that a typical diversified fund would invest in and choose to invest in stocks only from that sector. If you take what is called as thematic funds or themed funds, these are slightly more broad based. That is, they invest probably in a range of sectors within the theme. For example, if you take a sector like manufacturing, you can have a core capital goods company in it. You can have a pharma company. You can even have an FMCG company. You possibly can't have an IT company because it doesn't do manufacturing; it does services. So that's a very broad theme. Or if you take a theme like ESG, companies that are high on social responsibility, governance, and environmental issues probably score high and come into this filter. But they're not from any specific sector, right? So thematic funds are a lot more broad based. Sector funds are a lot more focused. uh, and please remember, some of them can be too broad a definition too. For example, opportunities fund. That's a theme, but what is an opportunity? An opportunity can come anywhere, right? So these are very broad based. There are also international funds which have sector or theme. I mean, there are international funds that will invest only in natural resources and new energy. There are international funds that will invest only in agri related commodities. Or you can simply have diversified international funds, which won't fall under thematic or sector. So broadly, this is how this universe or sector or theme funds are, offered by mutual funds. Now, the next question is, how do you, kind of understand whether a certain theme can last long, or certain theme is very, for only for specific periods or specific market phases. Unless you understand this, you may end up picking the wrong sector or the wrong theme at the wrong period. There are no very clear rules for this, but let me try and kind of classify. My colleague Bhavna has already done this with this article. You can find the full article below, but let me try and classify this based on what she has kind of detailed. One is that sectors that can be very cyclical. That is, they have periods of going up and there are periods that they go down. So the key is to catch them at the time, at the beginning of a rally, at the beginning of a takeoff, and not at their peak. For example, if you go to any screener or tool and look at the highest returning sector now, and you want to invest in them, chances are they've already delivered a lot, right? They may or may not have steam left. So the key in unlike choosing regular funds where you look at steady returns, you look at 3-year returns, 5-year returns, in sector thematic, it can be deceptive. So, understanding the sector, whether it's taking off, is very important. So, where is it very important? In sectors like banking and financial services, because banking and financial has its own credit growth. There are times when, interest rates are high, credit growth may not be high. As interest rates fall, banks may lend more and they may grow more. So, banking and financial services, infrastructure, when the country spends more on infrastructure development, there's a lot more activity, right? Similarly, commodities go through cycles. Metals have their own cycles. Agri commodities have their own cycles. So these pharma possibly somewhere in between being very cyclical and being very secular, right? This pharma has become more cyclical. For example, during COVID, pharma saw a wave, but post that abnormal returns that pharma stocks gave came down, right? So these are sectors where PSU is very cyclical. Typically, these are sectors where timing is key, right? But within this, please remember, there are sectors which are cyclical but can give secular returns. A very, very classic one is banking and financial. Banking and financial sector is cyclical. It goes through ups and downs, and even its fall can be really hard. But then holding for a long period of time does deliver for banking and financial. The same cannot be said of, say, a sector like infrastructure. If you are unable to book profits in a timely manner, the returns may simply dissipate in sectors like infrastructure. So that's also something that you should be aware of. In other words, now, timing becomes very crucial, and in many cases, like commodities, the exit also becomes very crucial if you decide to enter a sector fund. In other words, simply doing a long term sip on sector fund is unlikely to work for you, barring cases like banking and financial, like the said. In sectors like commodity, infrastructure, investing in lump sum or just in 2 or 3 phases becomes key, and booking profits in a timely manner becomes even more important if you want to really encash those profits. So let us look at, these are like more timing based sectors and themes. The more broad based ones, obviously, the ones that are less cyclical, consumption, whether it's FMCG, consumer discretionary, they are less volatile in their very revenue earning and earnings growth nature. If you go and check any company like a Hindustan Unilever, they may not see periods of very high returns, very high earnings growth and then periods of very low. They tend to be very steady, 14%, 10%, 12% growth, and so on in terms of their earnings growth. So these are less cyclical. They are cash rich, so they don't go through severe debt crunches, and also these are the typical characteristics of these non-cyclical sectors. So consumption is one, software is one, MNC. MNC, if you take MNC companies, they're very cash rich. They very steadily deploy money into their businesses, or where their cash is really high, they even give out rich dividends. These are companies that earn steadily. Their earnings growth do not go through ups and downs, etc., right? And broad based themes like opportunities, there will always be opportunities in some sectors or other, right? So you can't expect that theme to be very cyclical. So hopefully they will be able to generate opportunities at all points in time. So these are more broad-based themes. ESG, quant. Quant is basically a fund that will, use a set of filters to pick stocks. It's got nothing to do with a specific sector's fortune and so on. So in these sectors, the timing is less important. It is not like not important at all. Even consumption does have a little bit of uptick at times, and catching it, will make sense. Reason why recently you had a non-cyclical consumer fund coming out, the NFO, because consumers funds are picking up, consumer stocks are picking up, and so on. But you can afford to hold them for a longer period of time, because even if they go to a little bit of ups and downs, their earnings growth is steady, and that should deliver in terms of stock returns. So these are the two sets of broad classification that we are making. No, we are just trying to make it simpler for you by giving this, right? So that's the list here that you can see. You can go through this article fully to actually know which sectors, in which sectors timing is more important. Now, as far as your approach to investing in thematic or sector funds is concerned, you need to remember a couple of things. One is that if you have a very small portfolio, for example, if your overall portfolio size is 15 to 20 lakhs or so, you will not need to diversify excessively with these, right? You already have large cap funds, small cap, mid cap. Small caps and mid caps can deliver over the long term, right? So you can add a little bit of flavor of diversified international funds. That should do. Moreover, by in a small portfolio, you don't want to get hurt with the cyclicality that these sector funds give. It can really impact your portfolio if you invest, say, 10% or so. That will be significant in a small portfolio. So you can avoid when your portfolio size is small. If as your portfolio size grows, or if you're an extremely risk taker, but you don't know too much about markets and sectors, you should go with more of the broad based themes that we spoke of in the second part, right? We spoke of those consumption themes, software, ESG, so the opportunities, sector, themes like opportunities, nearly just an addition to your portfolio. They don't really hit your portfolio if any sector goes down. So you can still enjoy those additional returns. You will see that in prime funds in our high risk category, we actually have an opportunities fund, because we think people can use it. Even if you can't go directly to sector funds, you can use it as a diversifier. So we didn't put them under thematic, we put them under equity, aggressive. So you can use those kind of funds. But if you are a risk taker and you understand and follow markets a bit, or you even have a stock portfolio, you can supplement these kind of sector funds also. When you do that, it becomes important that you time your entry into such sectors well, right? And you should make sure you already have a well diversified portfolio. You can't possibly hold small cap funds, mid cap funds, and sector funds. That makes your portfolio extremely volatile and risky, right? So if you have some index based, say, large cap funds, and then you have some mid and small cap to some extent, you can add this as a kind of a kicker to your portfolio returns. And here, there are two approaches again. You can hold slightly longer themes, like I said, banking and financial, software or FMCG, where your exit need not really bother you too much. If you can time the entry, well and good. But otherwise, also they tend to deliver over time, right? But there is a second approach where you want to build a portfolio. You are highly nuanced. You understand markets, then you can keep just index funds as your core, and you can try and build a portfolio out of sector funds where once a theme goes off color, it is out of trend, you can exit that theme and enter new themes or new sectors. For example, a year back IT kind of peaked, and you could have booked profits in IT because the returns were quite high. And we did give, for example, a book profits call earlier last year in commodities fund, when the returns peaked. You could re-enter also. When I say book profits, you don't have to necessarily always exit. You could just take away the profits and leave your principal and so on. So that's another approach, but for this you should make sure you have some core of your portfolio. It need not be active funds, it can even simply be index funds, because you're anyways tracking the market, and you know which sectors are doing well, you might as well play it. But this is only for nuanced investors. If not, you know if you still want to build a portfolio of diversified funds but add a couple of sector funds, you could use prime funds. In prime funds, we have our sector thematic category separately, where we do add, as long as you have those in that list, it means you can still enter them. And as much as possible, avoid doing sips. You put them, and when there is correction, you can add, you can add in phases, but you can try and avoid doing long term sips in these kind of funds, except maybe banking, which is okay. you know a little bit in FMCG. Banking is cyclical, but at least because it's cyclical, you might be able to average over time, a period of time. So use sector funds judiciously. Use sector funds or theme funds only when you have a large corpus, and use more diversified themes if you don't understand or follow sector trends. If you do understand and follow, well and good, try and time them. Don't go for long term sips in them. We hope you found this useful. Do subscribe to our channel to get more such inputs.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.